Equity indexes have come a long way over the past few decades, says Guillermo Cano of Russell Indexes. While market cap-weighted indexes still capture the lion's share of volume, new entrants such as sector weighting, factor modeling, and smart beta funds are growing in popularity.
You know, people think of Russell, they do think of the Russell 2000, and they say, well, you're the small cap guys. In terms of creating an index, some of the indexes that we created from call it the legacy, the early years, are very simple because you're dealing with things that are market cap weighted. So the idea was, well, you could represent the large cap space. Now let's do something to represent small cap. And you basically held every stock in the portfolio at market cap weight. We then start slicing and dicing the market in different ways. And one of the examples is equal weighting. And in equal weighting, the idea is, well, I don't want to overemphasize my large names as much. I want to really diversify. A different way to do it is you say, well, let's first have equal weight sectors. And then within those sectors, we can equal weight the names. With factors, we basically decomposed the returns for stock returns into the most, call them fundamental factors or common factors. So we're looking at things like volatility and momentum and quality and value. And we're saying, let's construct indexes that represent those factors, and let's do it in a way that can be very intelligent. And we basically go out and we talk to clients and we try to find those things that they're trying to address, those needs they're trying to fill, and whether those needs are, volatility is too high or my exposures are too concentrated. That's the intelligence that we use to bring back internally and develop indexes based on that intelligence. The world, has been defined to date between passive and active. And there are things in passive where we refer to as our market cap weighted indexes that just represent the market. And on the active side, it is the active managers that have forecasts, that have skill, that have the ability to generate alpha. Now, as the research and technology has advanced, what we find is that some of the returns 10, 20 years ago that were being generated can be explained by these systematic factors. What we're trying to do is, in a way, you see that there's kind of a middle ground between passive and active that's being covered by what can be referred to at times as smart beta. But in terms of what we're doing today, we've moved beyond that market cap weighting, and we've moved into doing things that provide investors with tools that they can specifically get certain exposures. We've always thought that the way that this works best is when we have a robust ecosystem. And for us, the ecosystem comes from having, the index on one part of it to then having an ETF, and the ETF can lead to options, and then having a robust circle completed with futures and other derivatives. So, this works best in our mind and provides a lot of liquidity and value when we can make sure to have all those elements integrated in the market.